Welcome to another episode of RM Smart Investing. I hope everyone has had a great week so far. With the passing of Jim Simmons, who was a pioneer, a legend, a genius, I should say, a mathematician, um, who had really pioneered the algorithm and AI before its time. And I thought this might be a timely subject to talk about hedge funds. I know many of you are familiar with it, but sometimes there's this mystery about hedge funds and what are they? And we hear the names and we want to know. Hopefully, I can at least open the 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 doors to understanding them in a better terms, and maybe we will also have some terminologies that you might not have heard before. So hopefully by end of our session, you have much better, clear view of what are the hedge funds. One of the things about hedge funds, I think majority of people that get familiar with it is all of a sudden, all these hedge fund managers are buying, or private equity managers are buying all these sports teams, whether it's the NBA teams or NFL teams. If you are in Premier League, you hear from Chelsea to all the way goes to Everton and Arsenal and Manchester United. It's like all these families who've made tons of money, but there's a lot of connection with the hedge funds. But that's about it. So what we're going to explore today is, first of all, what is really a hedge fund? And what are its characteristics and how it differs from mutual fund, which a lot of people are familiar with, especially if they have retirement funds or 401ks. What are the risks associated with these hedge funds, and what kind of strategies uh, they use? And also, one of the biggest differences is how they get paid. How do they become so wealthy? When you think about some of the Forbes top billionaires, there are quite few of hedge fund managers listed there. Then at the end, we will look at some of the top funds, the largest funds, the best performing funds, and we finish it with the top fund managers. And these are the ones that end up buying all these sports teams. So, what is a hedge fund? Hedge fund is really actively managed investment pool. As you know, we have pooled funds, which like mutual fund comes into there will be the first one comes into mind, unit investment trust. We have closed-end funds, exchange traded funds. It's like, but these are the ones that there's one manager or a few managers who actually use many investors' money rather than each individual investing on their own behalf. So hedge fund works the same way, but generally they use leverage and they use borrowed money, and they use a lot of different strategies which is not open to other pooled funds. So generally what you have a general partner. It's almost, you look at it, a limited partnership or LLC. Generally you're set up as a LLC. They have a general partner and they come in, and then you have limited partners. So they're a silent partner. They put the money in and general partner invests it. So basically, again, the investor, we have the pool money, then we have a private manager who invests these. The whole idea when it comes to hedge, you would think, well, these are going to be more of a very risk averse and very conservative because it's called hedge fund. Well, their goal is to reduce risk because they do aggressive investing style in order to receive a lot of much higher returns. Uh, but unfortunately, it doesn't work all the time. And we will see that when we get to the risks, for instance. One of the things about, again, with the hedging, what that means, it doesn't just mean that we have one asset and you just go buy options. It could be diversification of that risk by using something complete opposite. Let's say you're in the travel world and basically, or you're in the cruise liners or investing in that line, you just go buy the, energy futures or energy related stocks. So that's how they hedge it. So that's basically when hedging comes to mind. So what are some of the characteristics? When you see about the characteristics, is number one, as I mentioned, the structure is different. It is, as I mentioned, it's a LLC, but they also use a lot of leverage. As you know, like for instance, in mutual fund industry, well, you can really use leverage, and you cannot, based on your guidelines, you can't really take a lot of risks, big risks. But that's what the hedge funds do. They sometimes there are a lot of them. They take advantage of uh, whatever knowledge they have, and they become too concentrated. Again, with the mutual funds and other pools, they are not allowed to do that. They have the guidelines. There's also something called accredited investor, which will look at that. Not everyone can invest in these hedge funds. And the reason for that is because these hedge funds are big risk. The hedge funds are really protected. They want to protect themselves, so they don't want to be sued, no liability suit. So they go after people who are, from the capital point of view, from knowledge point of view, they know the risks. Also, there's the low investment restrictions. What I mean by that is they really don't have any restrictions. They can go and do whatever they like, and they don't even share that. Most of the time, you don't know what they're doing. So mutual funds, as you know, they are very open. There's transparency. With the hedge funds, there's not really any transparency. You don't know what's happening. A big difference also is their performance fee. And that's again depends on a lot of these hedge funds. They make most of their money not because of the assets under management, but how much money they make. And we will discuss that, how these fees are calculated. Uh, Also, unlike like some of the mutual funds or other asset classes, they do have a lockup period. They also have lockout periods, which we will discuss. And but like most other pool funds, like mutual funds, they are SEC registered and they are RIAs and or registered investment advisors. So they are registered, but believe me, they are not really that as far as I mentioned about transparency, they're not that transparent. So it's a very low kind of registration. So I mentioned about the types of investors with the hedge funds. Generally, there's a lot of big pension funds and insurance companies, banks with a large capital they get involved. In some of the riskiest times, 25% of the hedge funds investments came from pension funds, which when the times are good, it's fine. But when the times go bad, like let's say 2022, for instance, that hurts. The risks are again supposed to reduce the downside risk by hedging, but because of the leverage they take, and that we will talk about in the risk, it actually negates that the name, the hedge. It becomes actually very risky. The fee structure, we will discuss it, is the 220. The liquidity is generally very low. We will talk about the lockup period and the lockout. Investment requirements, there's a minimum that they require. Some of them could be 5 million. Goldman Sachs is 25 million, for instance. Or there are some smaller hedge funds that they can require only 250,000. So those investment requirements is unlike, let's say, mutual funds, you can start with 1,000 or 100. And returns are supposed they have the potential to higher return, but you shall see that in reality, that's not what you're getting. And taxations, again, they don't have a tax pass-through status. So it is at the funds level and it can be pretty high. So that's one thing you want to pay attention to. I thought this is, the whole thing we can just summarize in this napkin finance. That, as I mentioned, they are lightly regulated investment funds. I actually, believe it or not, I've I've mentored actually some of my students who became the hedge fund managers overseas actually. And I had actually a couple of neighbors who started trading and they would come to my house and they sit down and tell me what they're doing. They just got into options. And I remember one of them just showed up and said, you know what? I want to start my hedge fund. I said, oh, how many years have you been trading? I said, oh yeah, I've been trading for 3 years. I'm doing really good. I think I deserve it. And then he actually went and registered. Uh, as I mentioned, there's a fee you pay and you do the registration. And basically said, oh, okay, I've so far, after like a few months, said, yeah, I've raised about 25 million, me and my partner. So the partner was really the marketing person. And he raised like 25 million at no time, no experience. He was not even in the business of investing. He just started trading. The times were interesting and he was doing good with his strategy. So that's how anyone can be a hedge fund manager. So one thing, as I mentioned, with this accredited investors, it's only open to wealthy investors. It is no restrictions. You are flexible. What do you want to own? It's not transparent. Then there are high fees. And as I mentioned about lockout and lockout period, there's restriction in cashing out. So as I mentioned, the hedge funds, when they say hedging, you would think that they should be conservative. They're hedging. Well, they don't all do this because unfortunately the word of L, which is that leverage, and then we have margin calls that when, as I mentioned, things are good, things work out. But when they are not, that's when everything goes badly. So, and the capital of hedge fund in the world is Greenwich, Connecticut. Of course, you can relate to that, Bridgewater and Ray Dalio. So how the structure is, now, as I mentioned, we have different kinds of investors. They come and they put the money in a hedge fund. Now, when there's like a really large, the portfolio manager, there's auditors administering the portfolio manager. He doesn't do all of these things. They have a group, they have legal advisors, or registrars, they have transfer agents. And then they go through the prime broker and they have executing broker. Now, the difference is when you have a prime broker really does the transactions for you. And they don't really have an inventory. They are not a clearinghouse. You rather have like executive brokers, which they have the inventory and they have the clearinghouse, so it's a lot easier to deal with. So, and you get a better executions. So that's what, depending on the hedge fund size, they would rather work with that. I mentioned about mutual fund because it's the most understood term. A lot of people, especially in the 1980s, 1990s, they got involved because of their 401k and retirement accounts. So with mutual funds, it's available to general public. But with hedge funds, as we mentioned, it's only a specific group. The risk management, there is supposedly low degree of risk management because of, again, it's a specific criteria. Their goal is to make money long term. For instance, in a lot of these mutual funds, with hedge funds, because of activism, there's a high degree of supposedly risk management. The mentality is more of an investment mentality with mutual funds. With hedge funds is more of a trading mentality. And sensitivity is low sensitivity to price entry and exit. Again, we are thinking about the sensitivities to mentality. With hedge funds is a high sensitivity to price entry and exit. And as we mentioned, the taxations, again, with mutual funds, they do have the pass-through, but also they have long-term gains and they are more efficient in some ways. On the other hand, hedge funds are heavy taxation. So we mentioned about these typical investors we call accredited for the hedge funds. And it's a pool that, again, the hedge fund wants to protect itself and they don't want to make sure that, as I mentioned, for liability reasons, that their investors know the risk. So what do? They go after wealthy investors. So they have a minimum annual income. They have a minimum net worth is $1 million, which again excludes your residents or their residents. And then also they go after significant knowledge of investments. So this is from FINRA. So we have $1 million minimum capital net worth, not including primary residence. Income for individual is 200,000 for the past 2 years, or 300,000 for joint with spouse for the last 2 years. So in reality, an organization, a trust fund can come as long as their net worth is 5 million, they can get involved. We talked about the individual's personal net worth, 1 million, and the 200,000 income, but also a lot of professionals and people that are in investment business, they have the knowledge, they also can get involved, as well as the partners or director of other qualified person tied to the hedge fund itself. So a lot of hedge fund managers themselves, they own their own fund. Um, so what do? They do long and short. They can go both sides of the market. They can use arbitrage. They can buy and sell undervalued securities. You can see how, again, flexible they are. They can trade options, bonds. They can invest in any opportunity, and they hedge it by reducing volatility. As I mentioned, it could be derivative instruments. It could be a different asset class or sectors or industry. So that's how they protect themselves. So based on that, now we talked about protection. Let's talk about the risks. Things, again, when you hear this hedge, you believe that, oh, there's a hedging going on, so we are protected. Well, not so, because they have their own risks. We talked about the transparency regulatory, so they're not exposed. So sometimes, actually, that makes them even bolder to take a lot of risks, and that comes to the investment risks. When the investors are investing in that, again, we don't have that transparency. There's a performance issues. This is a huge one, and we'll talk about this, the concentration risk, rising fees and prime broker dynamism, and mismatch or incomplete information, problem of plenty and taxation. So as I mentioned, anyone they can become a hedge fund manager. So you're really at the mercy of that manager and its team. So to make it even a little more simpler, which happens in the even exchange traded funds, some of them are more relevant in the whole industry, like the liquidity risk, operational risk, market risk. But this is a huge leverage risk. And then we have a reputation risk, because remember what happens, these hedge funds, usually it's the manager that you're really buying, and they need to that either the trust or they need that credibility, that the performance. And liquidity, we will talk about that more. So I want to show you this. This is Q1 2023, just using an example of top 5 holdings of some of the major funds. And you can see a lot of them own the same names. And then you wonder what happens to S&P when things are going well. You see that a lot of them are moved because of some of these major stocks. We call them Magnificent Seven. And when things start selling off, then you see the effects. So they're not only part of the index, but also a lot of hedge fund managers, they actually concentrate in few names. So what happens, that brings that leverage. So what they do, they not only concentrate on assets classes or few, let's say, stocks or, again, ideas, they use lots of leverage. And because of that leverage, again, when things are doing well, it's magnificent. But when things go wrongly, remember, there's that margin call. And margin call is when your broker, for instance, comes and asks for backing up that, the shortfall with assets. And that's when bad things happen. To use an example, if some of you probably not old enough to remember, but we had one of the most amazing hedge funds with the Nobel Prize economists, Nobel Prize winner economists. They were doing so magnificently. Look at what they did from 1994 all the way to 97. And then we had the Asian contagion, and then we had the Russian default. And just overnight, this is what happened. And not overnight, but you can see how even when the Fed or the United States Federal Reserve and Treasury, everybody wanted to save them. It could not. So what was the reason? Margins. They used leverage. There was like 32-1 leverage in long-term capital, and they just could not. They had bet the wrong way. It was coming to the bonds, and they just unfortunately they lost. So that leverage plays a role. Another one for some of our younger viewers and audience is the collapse of Archegos. Archegos was the capital management, which was an overnight success in a way. And they actually, this is in March, I think it was the 21st of 2021. They were managed with a gentleman who had come from nothing. And, he was a South Korean immigrant. And the fund moved all the way to $100 billion, had investors from UBS to Credit Suisse, and they used 6 to 8 times leverage, and they had gone against Viacom. Viacom came better than expected, and all of a sudden, overnight, everything went to nothing. And this manager, for instance, lost $20 billion of his own money that was in the fund in 2 days. So basically, it's all about leverage. So what kind of when we talk about hedge funds, they all have different strategies. So the major one I want to look at, I look at the big picture. There are 4, and then we have a lot of subcategories. As you can see, there are event-driven strategies, and as the name indicates, it all depends on a specific situation. It could be like even Apple's earning, that would be one, but usually like it's the political or operational, could be mergers, distrust, and again, this is a special situation, so depending on the event. The second one is called relative value strategies. And these relative value strategies are very much complicated. Not everyone really can do that. So they use these complicated formulas, fixed income convertible arbitrage strategies, fixed income asset-backed strategies, and so on. So what happens is, because of that could be very complicated, high risk, but also could be high return. So, and they use a lot of mathematical formulas. So relative value is of all the ones, which is the most complicated. But again, high risk, high return. Global macro strategy is the most understood and the most popular. They look at the fixed income markets, they look at derivative markets, equity, currency, commodity. And as I mentioned, a lot of as far as managers, when they go in, they like to start with global macro strategies. Then we have the equity hedge strategies. These are the ones they're called market neutral. They have the delta neutral. They long and equally they go short. They look at the imbalances. They look at the fundamental growth strategy, fundamental value strategy, quantitative directional, short bias, and sectors. So then we go look into a little subdivision of all these strategies. As I mentioned, it could be a fund just does short only. And, you have an investor who is investing in mutual funds, it's all long. They like to have to protect themselves. So maybe they want to be in a short only hedge fund, or they have long and short and go to both look at the inefficiencies, market neutral, merger arbitrage, convertible capital structure arbitrage, fixed income arbitrage, event-driven, as we mentioned, and again, I said the global markets. To dive in even more, you can, these are more of a reference, so you can look at the slides later. Again, we talked about event-driven arbitrage. They look at the inefficiency in the markets, could be international, could be sectors, segments, activist funds, and again, some of the favorites are global macro funds. When we look at the assets under the management, you can see the fixed income has the largest by far, And then we can see that emerging markets also bear an equity long bias, as well as balanced stocks and bonds. So these are just some subcategories of these strategies. When you look at the performance, and this was as of September 2023, you can see how they have performed. They're opportunistic and statistical arbitrage. You see, I mean, there's just so many different subcategories you can work on. The last but not least, I look at, in 2024, what was the trend of these hedge funds? What a theme they were looking at, and they were looking at the growth of alternative investments. They were focusing on ESGs, for instance, we've spoken in the past, technological development, and of course, many of you are familiar with which is happening in 2024 from the first, with the NVIDIA revolution in a way. We have machine learning and artificial intelligence, and of course, cryptocurrency. So these were the themes for the 2024. After all I have said and done, I thought this kind of summarizes everything. Now, here's a hedge fund specializing in highly complex derivatives and exotic financial instruments for discriminating investors. So that's the theme. And what do? Just buy gold. So anyway, just a food for thought. Again, you don't know what they're doing. It's just basically could be this. So one of the biggest advantages and disadvantages of the hedge funds, they are performance oriented. So the manager tries to do as good of a job as it can because it wants to get paid based on performance. Now, in Europe, it's a little more liberal than United States. So there are other countries. So we do have our own capital structure here. Over there, it's a little easier. You can be a performance fees oriented as far as a manager, investment manager. But in the United States, as I mentioned, we need to be an accredited investor. So one thing you want to learn is something called 2 and 20. And it's a fee structure that what that means is that the portfolio manager is the same thing as an investment advisor or mutual fund manager. They get paid based on assets under management, regardless of what happens to the markets. So the mutual fund manager could charge maybe 0.5% or 1%. In hedge funds, because of supposedly complications or complexity, they charge 2%. So that's fixed. Markets go up and down, they charge 2%. But majority of these hedge fund managers, they make their money on that 20. And that is the 20% based on performance of the portfolio. Now, lately, as I mentioned, we do have actually a couple of our members who are, they use like 1.5 and 15. So you have that choice that you can come up with the lower. So it's up to you. So you charge 1.5% on your assets under management and charge 15% performance. But generally, that's what it is, 2 and 20. So for instance, if somebody is managing the fund makes $200,000 portfolio and it was, $1 million fund, well, the manager makes 20,000 in management fees. And if there was a profit of 200,000, he will make $40,000 in just the performance fee. So you can see how that works. So in a sense, initially that's like a break point, but if it was more than that, then that the manager makes that 20 plus another 40. So, but there is something called hurdle rate, and hurdle rate can protect the investors in its high fees. And what that means is the investor can ask the hedge fund manager, listen, there should be a minimum rate of return on the project or in hedge fund investments before you can take profits. So what does that mean? That means two things. There is two ways of looking at the hurdle rate. Let's say you come into a fund and you say, you know what, the hurdle rate is, they say is 10%. That means based on the strategy they're using, they have to make 10% before they actually make that 20% performance. So there's something called soft and there's a hard hurdle rate. Now, the soft one is favoring the fund manager. So let's assume your hurdle rate was 10% and the manager actually made 12%. Well, because it passed that 10% hurdle, he's going to make 20% on the full 12% return because it passed that test. So the soft hurdle would be 20% of the 12% of the total profit that they make. On a hard hurdle, it favors the investors because the hard hurdle says once you pass that 10%, and we call that alpha, you only get paid on above that hurdle rate. So if that rate is 10% and you make 12%, you only beat your hurdle by 2%. So basically it will be 20% of the 2% rather than 12%. I hope that's clear. So again, you can see that most managers obviously would like to have the soft hurdle. There's also something called again, in hedge fund world and also in other places in investment portfolio management, something called high watermark. And what that means is imagine there's a huge volatility in the markets. And then, if the market really drops and you lose, let's say you had $1 million and now you have $500,000. Now, the question is at 500,000 goes to 700,000, which is 40%. Does that manager deserve to get paid? Well, this high water mark tells you that until you go back to the high of where you were in, you are not going to get paid. So until we get back to that performance that we were high, let's say for 2 years, this was the high mark of your performance or the assets. Until we break that, you are not going to get paid anything. So that gives more incentive to the managers. Number one, try not to lose a lot of money, but also try to make good money. So basically, again, you can see now we go here, we drop again until we go back above that hurdle mark or the water mark, we are not going to get paid. So that's is positive in some ways, but also negative. That's one of the reasons a lot of these managers, they actually start taking undue risk with a lot of leverage. Another thing specific, again, for the hedge funds is something called a lock-up period. Remember, these managers are investing in all kinds of things, which there are a lot of times it's illiquid or alternative investments. So incidentally, when you think about hedge fund in a category, it is considered alternative investments like private equity. So they're not, we don't go in the category of like equities, or they are alternative investments. But because they're investing in interesting and they cannot go in sometimes all in depending on that illiquid stocks, then they put this restriction on investors, telling them, listen, once you invested, you cannot touch your investment for a certain amount of time. Generally, it is 1 to 3 years. So once a accredited investor or pension fund has put their money in, a lot of times they cannot touch it for 2 years, for 3 years. So the manager has time to work with, and if it needs to be liquidated, they have enough time. That brings us to the second thing. There's a lockup, but there's also lockout period. So let's say now you want your money out of that fund. First of all, it has to be snail mail. It cannot just text it and say, I want my money. So it has to be certified. They will send a letter to the manager. It's written. And after that, receive that letter, in order to liquidate things or whatever, assets that they are in, it takes about 45 to 90 days. That's called lockout period. So basically, you could be in the fund for 3 years and 3 months, for instance, before you can see any money in your accounts. So I thought this was really interesting that hedge funds generate fees and little else. So when you compare the performance, this is interesting with 2009, 2018, you see how the S&P performed, just a corporate bond index, and this is what the hedge funds have done. So it is the reputation and also understanding that hedge funds. So let's take a look at some of the average performances of these hedge funds. This is, I mentioned, it's alternative investments. If you want to go, it's HFR index. And what you could see is every month, average industry, again, hedge funds industry have returned. And this is as of 2024. So basically, again, this is a little history. So for your own, if you want to compare some of the funds to that. And when we want to look at the categories, for instance, on the strategies, you can see, for instance, quant multi-strategy was up 13.1% in 2023, and all funds were up 7.68. Now, that doesn't sound really attractive when you just compare it to an index fund like S&P or NASDAQ. So just a thought. So either this hedge fund can be part of your total portfolio, just one segment of it, which a lot of, again, institutions do that with a specific goal. Otherwise, just an average investor needs to do that. It could just be in an index fund, for instance. To go even further, this is average returns from annual returns from 2011 to 2020 for average hedge fund. And this was done by Barclay Hedge Fund and NYU Stern School. This is the return of S&P, and this is the typical hedge fund. Basically, it goes back to this chart that, again, you see why it has been, not really a great success as far as really when you look at the alpha, for instance, they're generating is not really that average fund are not in there. As a matter of fact, these are the rolling 12-month excess return of hedge funds versus S&P. And in 2022, they were 21 basis point. They were below basically S&P. And you have to remember, we don't go too far in the, there's a, as far as the performance, there is something called Global Investment Performance Standards, or GIPS. And what it looks at, they look at the gross returns, but also the funds have to show the net returns. And imagine when you have the 20 and 2 and 20, a lot of these funds really not able to perform that well. So basically, you see, again, got to be very careful what kind of a fund you're choosing. Speaking of that, for the last few slides, I want to talk about some of the top funds. And when we look at, as of this is end of 2023, the top fund was Citadel. And again, this is more of a reference, so you can look at what year they started, how much they gained in billions, how much assets under management, and how much totally they have, made. We talked about Bridgewater, for instance, and the Renaissance Fund by Jim Simmons. So that's as far as the gains. These are actual returns based on strategies. Again, what we see how they have done in the past 10 years, 5 years, 20 years, the styles. But also, when things go wrong, my God, we got to be careful. And I'll have many stories. Again, being around for almost 40 years, I've seen things come and go. For instance, you can see the Tiger Global Management, which we talked about articles, and there was Tiger Global Management. They made like $3 billion in 2020, and 2022, they lost $1.6 billion. So, it's a kind of a feast and famine. I remember when the 2008, when we had the financial crisis, I met some clients I would be speaking in some events and conferences, and then some clients of these hedge fund will come and ask for my help, and I couldn't do anything. I specifically remember in January of 2009, and if you go back again, I lived through it, almost 65%, if I'm not mistaken, of all the hedge funds just closed. And I had like one client who owned stores, I mean, supermarkets in LA. And, he had put, that's a diversification, right? He had put like $5 million of his investments in one of the hedge funds. And he said he only get out, I think, 1 million out of that 5 million. So things like that also happen. So these are, not everything is rosy. So some of the largest hedge funds, this is as of 2023, is Millennium Management. Um, as you can see, 390 billion. We got Citadel with Ken Griffith, Bridgewater, which was Ray Dalio. So these are, again, references for you. We have Man Group from London, England. And again, we talked about Greenwich, Connecticut. Oh, I mean, Westport and Greenwich. I mean, we can see Connecticut is a big center of as far as the hedge funds. Also, asset under management as of 2023. This is as of June. These are the numbers that I could find, 97 billion. Again, that was Ray Dalio's. And overall, this was in 2022. You can see Ray Dalio went down a little bit, depending on how they calculate the numbers, but he was the king. For the longest time, Ray Dalio was the king. And you can see even in second quarter of 2021. So I'm just showing you the history. You see Bridgewater was 105 billion, Man was 78, and then Renaissance, Jim Simmons, was 58 billion. And as far as the top hedge fund managers themselves, you can see, Ken Griffith, James Simmons. Ken Griffith finally at Citadel, he topped Ray Dalio after 19 years for highest performing, and we talk about money-wise. So this was in 2022. This is Ken Griffith, and he made nicely over $4.5 billion in between the performance of his fund as well as his own fees. And then in 2023, we see the Israel Englander of the Millennium took over, but on the fees basis, still Ken Griffith did very well. Now, David Tepper, he made most of his money based on the personal investments. So again, this is as a reference. As a whole, over the years, Ray Dalio has made almost $50 billion in his hedge fund. Personally, George Soros, 3.9, Ken Griffin, and so on. So these are some of the top ones. I also want to go back to this beginning of financial crisis in 2007. It was interesting. John Paulson made $3.7 billion with his company. So just food for thought, who was doing well right before the financial crisis. And as far as the profits goes, these are the top 20 managers by 2023 profits. Again, we can see the Citadel and Millennium, and again, what year they launched. And the last but not least, before I go conclude our session, most of you are familiar with Jack Schwager, with his Market Wizards books. But also he has a book on hedge fund market wizards. If you're interested, you can read this. It's a pretty thick book, but he interviews globally all kinds of hedge fund managers and their techniques. And I think you will find it fascinating, especially if you do Audible, it's even more fun. You can go for a walk. So basically my last advice is, just make sure before you go to these, if you want to invest, and of course you're accredited investor, make sure you read the documents and look at their strategies. What is specifically they are trying to do? And understand the risks, understand the leverage, make sure there's no conflict of interest as far as by reading their RIA documents. And how do they value their assets? Is it, you know, the valuation? Remember, there's a lot of illiquid investments in these. So how do they do that valuation style? And what is their redemption policies? So these are some of the things, and also their fund performance. How is that calculated? So anyway, I hope this was helpful. I want to just give you a little heads up as far as, again, the little mystery on the hedge funds. I appreciate your time, your attention. And with that in mind, I would like to open up for Q&A. Thank you so much.